Well, for everybody who I see is joining at the moment this TLRP webinar or seminar, welcome. Thank you for joining. And I think we can get on with the formal introduction, and then we can get started. My name is Richard Cohen, and I'm the convener of the Taxation Law Research Program at Hong Kong U. And we're very fortunate today to have James Fock to speak with us. James is the author of a recently widely reviewed book called Financial Cold War. And we'll be talking today, the topic is creating equitable tax systems, challenges posed by financial markets. James is a veteran financial and strategic advisor to corporations and governments. He served as a senior executive at Hong Kong Exchanges and Clearing from 2012 to 2021 during a period of rapid internationalization in China's capital markets. Prior to that, he worked as an investment banker in both Europe and Asia, specializing in the financial services sector. This topic, creating equitable tax systems, is something which does indeed arise out of the research which he did for the book and is discussed in the book. As the flyer explains, rising wealth and income inequality have led to growing social tensions in many countries and have driven an increase in international frictions, particularly between China and America. One mechanism for addressing this problem is tax policy. However, not only have governments in major economies shied away from more redistributive fiscal policies, but in many cases they have pursued highly regressive systems of taxation. In this recent book, Financial Cold War, James Fock explores how the structure of the international financial system has contributed to growing tensions between China and America. Among other areas covered in the book, he specifically examines the role of taxation in contemporary financial markets and the risks posed by fiscal imbalances. Now, just before I finish and ask James to start, I just wanted to let you know we've just confirmed the PowerPoint slides that James uses. These will be made available on the Hong Kong U TLRP website. So you don't really need to take extensive notes, and if you wish, you'll be able to download them and look at them at your leisure. That's enough from me. Let me hand over to James. Thank you again, James, for joining us. We're lucky to have you with us, and we look forward to hearing what you have to say.
Thank you very much, Professor Cullen, for your extremely kind introduction. And thank you very much for everyone who's dialed in today for giving of their time to come and listen. I'm just going to see if I can share the presentation on the screen. Great, I think that's working.
Yep.
To be perfectly honest, I feel very underqualified to speak to you today. I'm not an expert in taxation, neither am I a lawyer. In fact, when I was at university myself, I spent so much time bunking off classes to go and backpack that it's a miracle that I actually ever graduated. That all being said, in my subsequent career, I did learn an awful lot about financial markets. I hardly need to point out to this group the profound importance of robust legal and regulatory systems to the proper functioning of society. Taxation likewise forms a key pillar in the social bargain between citizens, and the state. Today, I'm here to tell you that financial markets play also a critically important role in the maintenance of social and international order. So my presentation today looks at the intersection between financial markets, the law, and taxation, and specifically looks at the challenges posed by financial markets in creating equitable tax systems. I'm going to speak for about 25 minutes and then leave about half an hour at the end for questions. And I hope you will come up with plenty of questions that we'll have a lively discussion afterwards. Most people, or many people, think about financial markets as the place where young math whizzes go off to make avaricious amounts of money. If this is what you think, then I've got two pieces of news for you. One, you can also lose a lot of money in financial markets. But two, and perhaps more importantly for our purposes today, making money is merely incidental to the purposes for which financial markets were created. So what are those purposes? The purposes for which financial markets were created were, one, as a means for allocating society's resources, and two, as a mechanism for sharing risk. This doesn't sound like much, but in fulfilling these two social functions, financial markets have contributed immeasurably to human civilization and development. And to help illustrate what I mean by this, or how this works, let's say you are a young person with a big idea. In order to bring that big idea to reality, you need investment. Now, you may be very lucky. You may have a rich uncle who's able to lend you the money and off you go. But let's say that it is a really, really big idea. And the amount of investment exceeds the capacity of your rich uncle to support you, or perhaps your rich uncle, as much as he loves you, doesn't trust you enough that he wants to invest 100% of his savings in your big idea. In this case, you have the option of going to the financial markets where you can raise that investment from lots of different people with a surplus of savings. Each of them can contribute a small portion of those savings to back your big idea. Everybody wins. You get your big idea financed, and hopefully you go on to make avaricious amounts of money with your big idea. For the people who invest in it with their surplus capital, it gives them the opportunity to generate incremental returns that they wouldn't otherwise be able to get. And from society's perspective as a whole, it mobilizes unutilized or underutilized resources for the purposes of creating employment, investment, and innovation. So far, so good. But are markets the most efficient way of achieving these goals? There's a whole body of debate over whether markets are truly efficient. And to be quite honest, a lot of that debate is at cross purposes, because the reality is that the people engaged in it are quite often talking about different things, because there's no consensus on what market efficiency really means. I don't propose to engage in that debate here today, but there are three important things to bear in mind. First, markets reflect collective human financial decisions. And guess what? Human beings are not always rational. There's a great body of work created by the Israeli psychologists, Daniel Kahneman, Amos Tversky, on behavioral finance, which talks about this in more detail. But if you haven't read that and you won't take my word for it, then you're welcome to come and speak to my wife in the morning before she's had her first cup of coffee. Second, markets are driven by incentives. There's a great quote by Charlie Munger, who's the longtime business partner of Warren Buffett. Show me the incentive and I will show you the outcome. Incentives are created by institutional frameworks of laws, regulations, and conventions within which financial markets operate. Third, markets have no natural tendency towards equilibrium. This may go against what you've been told, but to illustrate this point, I will tell you that markets allocate resources based on the ability to pay rather than on pure merit. They also reward capital. Left to themselves, therefore, markets tend to lead to a concentration in wealth. And often this is because actually the very wealthy can use their wealth to help entrench themselves. Financial cycles have had a very profound effect on the course of history. The chart on the left shows the percentage of the US national income that between 1913 and 2021 was earned by the top 1%. That's the blue line. And the bottom 50% represented by the red line. The early 1900s was the era of the robber barons. In Europe, this was called the Belle Époque. And this period was characterized by very sharp inequality. And you can see that in the chart by the fact that over 20% of the US national income at that time was earned by the top 1%, while the bottom 50% had to make do with less than 15% of the national income. This led to huge social tensions. In some countries, this precipitated violent regime changes, most notably at that time through the communist revolutions that ushered in the great experiments in communism of the 20th century. The communist system basically eschewed financial markets in favor of instead the state allocating resources. And the intention was to create much more equal societies by allocating to each person pretty much the same or pretty much what their needs were. The problem with this system was that it removed incentives for people to work hard and to innovate. And ultimately, most of these systems stagnated and went into economic decline, which caused a reduction in the standard of living for everyone. In most of the West, you also had significant redistribution, but this wasn't done through violent means or through revolutions, but it was done through much higher levels of taxation and much higher levels of public spending. And you'll see in the middle of the chart on the left, effectively over that period in the middle of the last century, a big reversal in the level of wealth and income inequality. The problem here was that even in the West, over time, governments became inefficient in their spending, and the demands required that they levy extremely high rates of taxation, which became disincentive to work and disincentive to innovate. This led to the pendulum swinging back all the way back the other way with, in the 1980s, the rise of free market ideology. It was effectively deregulatory, and it was about cutting taxation. These policies were very, very successful in driving much higher levels of economic growth, but also predictably, they contributed to much higher levels of wealth and income inequality. And in fact, Hong Kong, as one of the poster childs of the free market system, has been at the front end of this. We've experienced ourselves very high levels of wealth and income inequality, which have driven the social tensions that we've seen here and in the rest of the world in recent years. The lesson of the last 100 years, therefore, is that neither an excess of markets works, or neither does the state taking over the role of allocating resources on its own work. If we are to avoid repeating the same historical mistakes of the past, then we need to find a balance between the two. And the key levers for the state to intervene in markets, and this does not preclude the state directly allocating resources itself where it feels it needs to, but the key levers for the state to intervene in markets are through laws and regulations, particularly around competition policy, innovation, and the prevention of entrenchment of incumbent companies or elites requires competition. Also requires a certain level of social welfare support. And key in today's world, where economic growth depends far more on brains than brawn, it requires huge investment in education such that each person has the opportunity to fulfill their full potential. These are all underpinned by fiscal policy. At this juncture, I should take a few moments to talk a little bit about the evolution of the philosophy underpinning tax system, because it has changed significantly over the last few centuries. Before the 19th century, taxation was a necessary evil simply to fund the most basic functions of the state. These included raising an army to prevent external invasion, maintaining a basic police force for the maintenance of domestic order, and the maintenance of a court system to arbitrate disputes. During the 19th and 20th centuries, as the world urbanized and industrialized, more modern societies called for greater levels of infrastructure and social welfare, which led to significantly increased tax burdens. This, of course, was redistributive, but the philosophy underpinning the taxation system was still largely focused on raising sufficient revenue needed to run the state. In the 21st century, it is reasonable to argue that there should be a specifically redistributive mandate for taxation. This is because we understand from the historical experience that concentrations in wealth have tended to lead to entrenchments of incumbent elites, which has in turn, over time, led to social tensions and upheaval. So perhaps the way to achieve this is to levy much higher levels of inheritance taxes in order to prevent those dynastic elites from being formed in the first place. But this is a problem that's also being made more urgent by advances in technology. Over the last 30 years, you've seen a huge wave of automation in the industrial sector, which has led to massive displacement of manufacturing jobs. Over the coming decades, with the advent of machine learning and AI, we're likely to see even very high-end service sector jobs start to become displaced. This has led to the recent proposals around a universal basic income. Universal basic income is effectively a minimum level of income that the state provides to everyone so that they cover their basic needs. I'm personally not a huge supporter of universal basic income in the long run, but for two reasons. First is because I believe that work forms part of the fundamental social contract between the individual and the state. But perhaps more importantly, I believe that work serves a more important purpose than simply meeting people's basic material needs. Work forms a part of each person's social purpose and dignity. And just simply giving people money to exist may leave people feeling somewhat displaced or despondent. This is a problem that each nation and society is going to have to grapple with. Oops. However, in calibrating the appropriate fiscal policies for themselves, each country is going to have to contend with certain challenges posed by financial markets. As trade and investment has globalized over the last century, what you've seen is that each country has looked to attract investment to itself. And one of the means through which countries have sought to do that is through fiscal competition. This included lower corporate tax rates, fiscal subsidies, and so forth. But from the financial market perspective, it's also included significantly lower rates of taxation on income from capital versus income from labor. This basically arises from the fact that capital is much less mobile, or much more mobile than labor. You can move money at the touch of a button, whereas if you want to move to a different country, you have to sell your house, you have to move, you have to find your kids new schools, etc. It's much more difficult. And so the temptation for governments has been to tax labor at much higher rates than capital, the result of which has been incredibly balmy tax systems in which the very wealthy quite oftentimes have paid far lower rates of taxation than average middle class workers. The bottom line is that in a globalized economy, each country's ability to tax is highly affected by what other countries do. So how can this problem be addressed? The answer, very simply, is not very easily. Improved transparency on the issue over the offshoring of wealth by the rich or the corporate tax shifting mechanisms used by multinational corporations has helped highlight the issues. In the past, countries have used things like capital controls in order to prevent money or capital being leaked out of the country for the purposes of avoiding or evading taxation. The problem with capital controls is that it tends to reduce international trade and investment, which means that if widely implemented, the world will be much poorer for them. There's also, frankly, a question today, given technological advances in things like cryptocurrencies, whether or not capital controls can be as effectively enforced as in the past. Therefore, as far as I can see at least, the only real way of tackling this problem of international fiscal competition is through global cooperation and the setting of minimum global standards. In this, we might be heartened to see the G7 agreement last year on minimum global corporate tax rates. This is a good first step, of course, but arguably it doesn't go nearly far enough, and certainly the rules need much more teeth in order to make them effective. Ultimately, this will not be easy, particularly in the fraught geopolitical environment in which we find ourselves today, and many will be reluctant to do it. But understanding the consequences of not doing anything about this, then I don't think it's an exaggeration to say that this is something that is at least as important as things like nuclear non-proliferation treaties. What is at stake is global peace, stability, and prosperity, and the future of our children. Thank you very much. I will throw the floor open for questions.
I think we're people are thinking about what's being said, and I'm sure we'll see some questions shortly, but I've already had one or two myself. Firstly, James, let me say thank you for a particularly lucid explanation of some key macroeconomic factors and how they shape the way political structures have developed, and particularly fiscal policy. I think it might be useful to ask you if you could elaborate further on something which you mentioned in passing. I see we already have one question, and I'll go straight to that after this one of mine. But you mentioned inheritance taxes. So could you elaborate a little bit on your understanding of the nature of them and why you think they are equitable in the sense of being fair overall to most parties, how they operate and what the difficulties are we face in bringing them back? I know, just by way of introduction, they've gone in Australia. They've been removed totally. When I was growing up, they were everywhere. There was a federal inheritance tax, there were state inheritance taxes, but it only took one state to abolish them, and then everybody else had to give them up because of this, an early version of this fiscal competition policy. The state of Queensland was attracting people to retire because the climate's nice, but they wanted more skills, so they abolished inheritance tax. And even more people rushed to live in Queensland. So all of the states like Victoria, where I come from, where the weather is less sunny and lovely, fairly shortly afterwards ended up abolishing them too. So now we have none in Australia. And a number of tax policy people say not a good thing. But I'd be interested in your further views.
I think, first of all, I would say that taxation forms a key component of the incentive structures for enterprise and innovation. And one of the drivers for entrepreneurs is to create wealth that they can enjoy during their lifetime, and to a certain extent to be able to pass that on to successors. Now, levels of taxation that redistribute during one's lifetime, if they're very high, can be big disincentives to enterprise. And you want to incentivize people to create jobs and to innovate. Typically, though, over the life cycle of generations, and there's obviously the saying about from rags to riches to rags again in 3 generations. Sometimes you really do have some very successful wealth creators who contribute very significantly to society. But over time, what happens is that when individuals reach a certain level of wealth, they have a surplus that they no longer need. And the surplus tends to be more and more put to less efficient uses. I'm not saying in every situation, but the tendency in aggregate is for the surplus or the capital to be used for less efficient means, and it becomes used for the purposes of wealth preservation rather than wealth creation. And so obviously you can't legislate against, you can't legislate to create equality of outcomes. The reality is that in any situation, different levels of aptitude, ability, skill, industry, and even luck are going to drive different levels of lifetime wealth and earnings accrual. But what society should be looking to do is to make sure that in aggregate, the system is continuing to recycle wealth in the most advantageous way for society as a whole. And so at the end of somebody's life, it seems like the right juncture at which to impose a heavy taxation. Now, you asked about the problems with doing that. I mean, Hong Kong's the poster child for this problem, because we are an open economy, we've got open capital markets, and if you set that rate of taxation too high, people will simply just move their money out of the jurisdiction in order to avoid it. And that's really the big problem with imposing these taxes. And so if Singapore has no inheritance tax or Australia has no inheritance tax, it's very difficult for us to impose an inheritance tax and maintain our open markets as they are. So ultimately, I think this requires some level of agreement on global minimum standards, and the requirements of each different society are likely to be different. But I still believe that inheritance taxes could serve as one means of avoiding the entrenchment of class hierarchies that are so dangerous to the long-term social stability.
That's better. Yeah, questions are mounting up, and let's move to them in a moment. But I'll just add one point, clarification with respect to Australia, and this is relevant to Hong Kong as well. Some years after the abolition of all of the inheritance taxes in Australia, capital gains tax was introduced, and it's immensely complicated. And not for the faint-hearted, filling out the form, but it works and it collects a lot of money. One of the things it does is produce a de facto inheritance tax, which has actually solved the problem of the old system. The old inheritance tax system, one of the main complaints was that people would die and pass on assets, and then the probate bill would come in, but there was no liquidity, particularly if they were fixed assets like a house or something fixed. And so people were forced to sell often in a hurry in order to pay the tax. So it was a problem. Nowadays, with capital gains tax, as I understand, what happens is if, let's say, a father dies and passes on the family house to a son, there's no capital gains tax which has to be paid immediately, but on the next disposal of that property, then the tax comes in. Previously, property in the hands of the father was exempt from capital gains. But once you transfer it under will, it no longer is exempt, and so eventually is paid. And perhaps it's difficult to work in the inheritance tax system without having capital gains tax. But enough from me. Let's go now to the question. If you click on the Q&A, you'll see them there.
Yeah, I see the Q&A. Shall I go through them directly?
Yeah, sure. Let's go through them.
So from Martin Matsui, am I in favor of global minimum tax? Look, I'll first of all say that I'm not in favor of paying more taxes than is absolutely necessary than the next guy. That being said, I do believe that if you're going to affect fairer systems and particularly create more progressive systems of taxation, then I do believe that countries need to set certain minimum standards in order to avoid the very pernicious and harmful race to the bottom through global fiscal competition. BCP, with more and more goods purchased from online suppliers who can easily ship across state and national boundaries, and with it also being increasingly easy to do one's banking in other jurisdictions, how much risk is there that increased use of the internet will create a whole new type of tax haven where a whole range of taxes is no longer able to be collected in the states and countries where people live? I think the changes in technology ultimately, I think, can have good and bad effects. The bad effects are obviously that it has made capital even more mobile than it already was, and so hence there is a greater likelihood of capital being moved offshore to take advantage of lower tax regimes. But I think equally, new technologies have enabled greater levels of transparency than we have ever had in the system. And in this way, so long as countries are willing to work together on minimum global standards, then the transparency that new technologies provided give a means of actually enforcing some of those standards.
Okay, let's see. There's another one now.
Is inheritance tax the only response? Would a tax like global GST help? I'm not personally in favor of GST or sales taxes, simply because they are inherently quite regressive. The reality is that lower income earners inevitably spend a higher proportion of their incomes, and so it will inherently bear the higher brunt of sales and taxes and GST. So I'm not necessarily in favor of a global GST, and I believe that GST can be significantly distortive as well.
Perhaps I could just add again a few words there. And I'm aware of that argument, and it is a sound one, but, about the regressiveness, and you can't do anything about it, certainly. But it's interesting that when finally a GST was agreed to in Australia, after about 20 years of debate on and on, the thing that pushed it over the line was the social welfare lobby got behind it. They said it was a good thing. And the reasons they said it was a good thing, the government discussed it with them. that was in order, in the case of Australia, to underpin the general tax base, which obviously was supporting government social welfare measures, huge number of them. And going back to the point you made earlier about the difficulties of raising income tax levels, the social welfare lobby were persuaded that looking to income tax at that increases at that time. We already had a capital gains tax in Australia. The GST in Australia's case made sense. Certain provisions were put in to control the level that operates at 10% of the GST, but it has been a very effective revenue raiser, and it's relatively efficient in the sense that the costs of actually administering income tax lower.
I can certainly see advantages in terms of the cost of administration because it's a relatively straightforward and simple tax. It also avoids, quite difficult and more fraught questions of income taxes or other forms of taxes. And ultimately, you don't necessarily have to spend the money. So in some ways, it can be argued that GST is an optional tax. But that being said, it doesn't take away from the argument that in aggregate, it tends to be more regressive. And so in that sense, it is something that contributes to greater wealth and income disparity rather than redressing it. I do have, that all being said, I do think that, that there are certain types of sales taxes which may be appropriate. And I think, currently with the climate debate raging, one of the key issues one of the key challenges in reducing carbon and other greenhouse emissions is finding a way to properly charge for them. It is clear that the cost of carbon emissions in many countries is simply not reflective of the damage that it does to the environment. And in that sense, there's an argument for certain types of goods that create social harms and which create a burden on society, such as petrol, such as smoking that potentially puts a strain on medical systems. Those types of things should be taxed at point of sale, but more as a means of discouraging their use in order to find other alternatives which don't ultimately create such a burden for society.
There are some more questions there as well.
I'm just looking through here. So AJS 88, what further steps do you believe that the OECD G20 should take to make the BPS 1.0 and 2.0 as effective as possible to maximize international tax cooperation and reduce inequalities? Well, I'm not an expert in this area, but from my reading and understanding, the reality is that there still exist a lot of loopholes, particularly in things like the requirement for individual countries to tax their earnings within those countries at a minimum rate, but not to exact the offshore earnings of companies in those jurisdictions at a certain minimum rate. And that creates the opportunity for arbitrage and avoidance. But these are obviously areas where it requires a huge amount of detailed negotiation and a huge amount of focus on the detail of implementation. Recently, China is advocating for common prosperity, some sharp measures were taken forcefully for famous public figures. What are my views on that? In short, I think that common prosperity in principle is a really good thing. That being said, I do believe that in order to preserve China's interests in the long term, and the interest being to ensure the continued incentives for people to invest in the country and to innovate, there needs to be clear due process in the enforcement of measures. And so while I'm very supportive of common prosperity, I believe that there are certainly improvements that could be made in the way that the measures are enforced, and particularly ensuring that there is due process in the carrying out of policies in their pursuit. Okay. Charlie Bigard, what are your thoughts on financial market taxes like in France, Switzerland, and the US? I assume you're talking about financial transaction taxes here, and so taxes on securities trading. The reality is that this is an area where it really depends on what other countries are doing, because it is an area that is very susceptible to international fiscal competition. The reality is that financial transaction taxes reduce liquidity in financial markets. And this is why many players in the financial services sector have been significantly against them, because they dampen trading activity. And that there is a real cost of that, because when you have lower liquidity in markets, you tend to have higher spreads between the bid and ask price, which ultimately feeds through into higher cost of capital for companies that have to raise capital from financial markets for investment. That being said, I do believe that there is a very strong argument that financial markets have become excessively financialized, and where secondary trading doesn't really provide capital for new investment or innovation, that is just money being recirculated in a secondary market casino. And in fact, the fact that you have so much capital being allocated to secondary trading could actually take away capital that might otherwise go into primary investment in innovation and the creation of jobs. I think that this is something that countries should certainly look at, and where it is felt that markets have become excessively financialized and are no longer serving the overall benefits of society, there is quite a strong argument for imposing financial transaction taxes, but with the proviso that unless there is a global minimum standard setting a financial transaction in one jurisdiction alone is simply likely to remove financial activity from that jurisdiction to other jurisdictions, rather than to drive the primary investment, which would be the objective of creating the financial transaction tax. Next question, what is the top priority Hong Kong could take to reform its taxation regime to reduce the wealth gap? This is a very good question. So in many ways, Hong Kong is in a hugely privileged position, and in many ways it is not. And the ways in which it's not is that because we are so dependent on financial services and open financial markets, it's very difficult for us to enforce taxation because it's very easy for capital just to pick up and move if they don't like the taxes here. That being said, Hong Kong, because of one country, two systems, effectively operates as a city-state in that the taxation that is levied here is not taken away or does not have to go to contribute to building roads in Xinjiang or hospitals in Tibet, unlike Shanghai or Beijing or other Chinese cities. And hence, as a city-state, there is huge efficiency in our infrastructure spending because of population density. And so the reality is that Hong Kong, and we, apart from that, we also have very significant accumulated reserves. And so in that sense, Hong Kong has the capacity to significantly increase our public spending on key priorities that will help drive our long-term prosperity and help alleviate some of the social problems that we've seen. The two key obvious things there being, one, greater investment in public housing, and two, significantly greater investment and improvement in quality of education, particularly at the early stages of education. Next question. Do you think the EU carbon border adjustment mechanism can have an impact to mitigate climate change? Yes, I think ultimately, if there are proper charges on the use or the emission of carbons, I think that it is likely to help tilt the scales in favor of alternative means of energy generation, whether it's in renewables or otherwise.
Okay, one of the people watching, attending, kindly pointed out that my voice was breaking up when I talked before, so I won't talk too long, but I have switched to another bit of equipment now, and hopefully this microphone may be better than one that's talking to the computer that I'm using.
I can hear you loud and clear now.
Okay, well, that's good to know. I'll remember that for the future, and thank you to the person who threw that to my attention. That's really helpful to know. I'm learning about Zoom all of the time, I find. Well, it's been a terrific discussion, and I'm really pleased too. We've had some very good questions which have helped move it along. And you made some good observation in response to that last question about the nature of the strengths that Hong Kong has, and I agree with you about that. And as we've talked about before, I think despite the fact that it's often given a lot of criticism, I think the public rental housing system is a remarkable achievement as well. It started around about 70 years ago, which plays an important role. But I thought just to finish, you might be able to make some short comparative observations. Do you think that Singapore has found a way, not a perfect way, but a better way to deal with the way or these inequalities which you've been talking about? Because it operates as a very significant international financial centre, a big part of what it does. But is it doing a better job than most places in trying to find the kind of balance? And if so, why might that be? I know this is a bit speculative, but we've got a little bit of time to do that.
Yeah, I think I got most of that question. It broke up a little bit, but just so that I'm sure that I understand you correctly, are you asking if Hong Kong has generally done a better job in terms of addressing wealth and income inequality than other places, or was the question
No, I
something
was
different?
really suggesting maybe, would you think that Singapore has done a better job?
I do believe that Singapore has done extremely well in terms of addressing some of these social problems, and I think they've done particularly well in terms of their housing policies. They've created a vast and very reasonable and high standard public housing system, which I think is something that 80% of the population lives in. And so in that sense, I believe that they've done very well. They've also done fairly well in terms of setting up things like their pension system and so forth to ensure that they have fairly sustainable funded regimes for long-term care. The Singapore model, I think, is not a giveaway model, and that I think is really important. So Singapore does provide good levels of social welfare, but if you look at their medical system, although they provide universal medical care, each doctor's visit requires some payment, which is low cost and high standard, but it creates a disincentive for people to abuse the system. And I think that's really important, in that ultimately taxation systems and the maintenance of social order depends on the social contract between each individual and the state. And while many people blame the state quite a lot of the time when things go wrong, the reality is that the state and society as a whole should expect certain things from each citizen. And in that sense, I think that Singapore has struck a fairly good balance of providing strong social provision, but maintaining a high level of responsibility on the individual. And I think in that sense, I don't know specifically whether they've done much better than any other place on wealth and income inequality. But the reality is that Singapore has fairly high levels of wealth and income inequality, and as an open financial center like Hong Kong, they face many of the same challenges in that regard. But I think that if you look at the details of what they provide, and a lot of this ultimately, the devil is in the detail, they have struck a fairly good balance in the social contract between the state and the individual.
Well, thank you, James, very much for the presentation. I see we're now just about finished, and given the breakup problem, I won't talk too long, but really you've given us a lot to think about, certainly me, but I'm sure all of the people who have participated. And you get me thinking. I'll just finish on this point perhaps, and that is, as we've discussed, what the responses might be to this inequality problem, driven ultimately, as you say, by the way the markets have been allowed to develop and operate. Not only that's been important. It strikes me that particularly places like Hong Kong, and it seems like Singapore as well, remedies are needed, but the solutions may involve not the conventional responses, as it were, which apply in much of the Western world, but somewhat more unconventional responses, which are significant, but which build on those aspects of the system here in Hong Kong and in Singapore, which we know work fairly well, rather than moving to a standard sort of Western advanced welfare system. I'll finish on that point, but was there anything else you wanted to say?
No, just simply to say thank you very much, Professor Cullen, for having me here to speak today. And thank you very much to everyone who's participated.
Yeah, thanks to everyone. And we'll see you at the next seminar. We've got one coming up in March. Very important Peter Willoughby lecture, I think. And I look forward to seeing you then. And I'll make sure I have better bandwidth and better connection at that time. Thank you very much, John.
Thank you. Bye-bye.
Bye-bye.